Good afternoon and welcome to the second quarter AAMA market commentary. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, AAMA's Chief Investment Officer. Hey, Phil.
Hey, Bob.
How are you doing?
Good. Good.
Super. Um, Let me do a quick introduction to AAMA first, and then we'll get into the meat of the commentary. AAMA is located in Dublin, Ohio, and we manage about $1 billion in assets under management and advisement. And as a investment advisor, we do a lot of fundamental work through our fundamental discipline to track the markets and guide us through allocations that we make within the portfolio. Our investment team is highly experienced. Each of us have more than 30 years on average. And it gives us a deep knowledge of the markets and the cycles that we've been through and what we're looking to it in the future within the portfolios. And we place a premium on being accessible to the advisors we serve. Anytime you can call us, email us, and we'll be happy to chat with you about the portfolios and our views on the markets. So let's get into the commentary. And what we're seeing here in the second quarter is there's been a significant skewed view within the markets. Phil, do you want to kick this off?
Sure. For those of you who don't track the indices daily, the Dow Jones Industrial Average hit its peak price level in late March. I think it was March 28th, actually, last day of the quarter. And since then, the media has talked about the new highs, fresh new highs in the S&P 500 and the NASDAQ. But it's been a very concentrated market. And I think most of you probably know this, but just to put it into perspective, the average stock in the S&P 500 actually declined 2.6% over the quarter. Average mid-cap stock 3.5% and small cap 4.5%. So obviously there were some stocks that did very well, but a very large number that definitely underperformed the headline S&P 500 return for the quarter. The bond market was also unremarkable, and the Barclays average index pretty much unchanged. Long-term Treasury bonds lost again, minus 1.8, and Treasury bills were up 1.3%, with a near-term yield of 5.3 on 90-day bills. So it's been a concentrated market. And if we look at all U.S. equities today, and this is not just the S&P 500, but all U.S. equities, 10 stocks represent 27% of the value. If you look at just the S&P, those 10 stocks are pushing 35% of the S&P 500 index. And names you'll recognize, market leaders. So it's been a very concentrated market. And one way to look at it is to look at the relative performance of the unweighted S&P versus the cap-weighted S&P. And it's just now hit a new low in relative performance compared to the lows of 2008 and 2009. We had a rally in the unweighted average on a relative basis, 22, 23, but it's given back all those gains and is at a 15-year low. And I think the key question, and this is a situation that most people are pretty much aware of, but the question is, how does this get resolved? And obviously, the leaders that comprise the 10 stocks could falter as a group or individually and turn this around. The other way this could be resolved is if the broad market were to perform better. What we would suggest is that this broad market weakness is heavily correlated to two things. One, interest rates, and two, the general economy. And if you think back at the beginning of this year, the market had priced in or expected 6 Fed rate cuts within the calendar year. That's down to somewhere between 1 and 3 now, call it 2. So there's been disappointment in the interest rate expectations. And in fact, longer term rates have not come down significantly either. So the average stock in the S&P 500 has debt, has interest expense. The leaders tend to be cash rich and probably earn more interest than they're actually paying. Certainly Berkshire is in that position, and Microsoft, Apple, etc. So interest rates do not affect those stocks nearly as much as the average stock in the unweighted index. We'll get into the interest rate complex in a little bit, which relates to inflation. But not only is the U.S. market concentrated, the international market's concentrated as well. So U.S. stocks make up 72% of the world index. And one little fun fact is that Microsoft makes up 4.5% of that index. All of the stocks in Britain make up 4%, France 3%, and Canada 3%. So Microsoft is bigger than any one of those countries on an individual basis.
That really puts in perspective in how concentrated the markets are, and that's kind of mind-boggling when you think about it. One stock can have a size that's larger than those three markets individually. So let's roll ahead to inflation. And, we've seen inflation go from some low levels to some high levels and come back down. But Phil, give us a little color as to the way we track inflation to kind of smooth out these spikes and what we're looking at.
Sure. There's been some better inflation news recently where the headline and underlying inflation indices have cooled off a little bit. But it's primarily 1 month, couple months. And if we step back and look at the Federal Reserve's framework that they say they are following, number one, they will frequently talk about 3 and 6 month moving averages of inflation. So what we do is we take the monthly inflation rate, annualize it, and then we run a 6 and 24 month moving average. So the 6 month average of the Fed's favorite inflation measurement, that's core services, X energy and housing, the 6 month average is at 4%, up from 2.6 just 6 months ago. So the improvement in inflation on a 6 month basis that we were looking at last year is gone. So in our mind, based upon what the Fed says their framework is, there's no justification for them to cut rates at this point. They change their framework or they decide to look forward, that's their prerogative. But based upon their espoused framework, there's no justification currently to raise rates. One of the things we mentioned about the potential reasons for the broad market to be underperforming is a slowing in economic growth. So, we hit a close to 5% annualized rate of growth third quarter last year, and it's been declining since. Fourth quarter last year, just over 3. First quarter this year, 1.3. And the current estimate for the second quarter of this year, yet to be announced, is 1.7. So there's been a cooling in the growth rate, but it's not gone negative. It remains to be seen, obviously, where this heads, but early indications for the third quarter that we just started are that we will continue to see growth, probably not near the peaks we've seen recently, but in the 1% to 2% range. And we know there's always going to be a recession at some point. The question is when. Our job is to try to put that on the calendar at some point, and we've been, for the last couple years, since the Fed has started raising interest rates, we've been pretty steadfast in saying that there's not going to be a recession. That's turned out to be correct. But we're starting to put the possibility of a recession developing on the calendar possibly starting early next year. Obviously, that's just a forecast. We don't have a strong look at any of the numbers, but general trends, consumer spending, imports, exports, et cetera, and investment in particular in housing are suggesting that this slowdown that we've seen now for 3 quarters in GDP could continue to weaken. So we've put the potential recession out into the first of next year.
Now, how have operating earnings played into this too? They've been declining and are projected to increase, but give us a little insight on that.
Sure. The peak in operating earnings was the fourth quarter of 2021. And, again, the media focuses on how well companies meet or beat their or fall short of their expected earnings reports. Those are always managed. Generally speaking, 12-month out earnings get revised lower by 5 to 8% over that 12-month period. And so the bar gets lowered. Second quarter of this year, which we just finished, we'll start getting reports here next week. But the expectation is that earnings will finally exceed the peak that they posted in the fourth quarter of 21. Obviously, those estimates can change, but we're pretty close to reporting, so they tend to be pretty accurate. Then expectations are for earnings to accelerate to 10 to 13% above the peak we saw 3 years ago. So we've been through a little mini recession in earnings. It appears that that's behind us, and forecasts, as usual, are pretty rosy. So this quarter will be important, as every quarter is, to see if, in fact, we do manage to exceed that prior peak and how the earnings reports affect the expectations for the next 12 months.
And thus we say unremarkable for the second quarter.
Yeah, certainly the markets were unremarkable. Earnings may or may not be. We'll see here in the next 3 weeks as we get the bulk of the reports in. But the market prices were certainly unremarkable.
Then before we close things for today, give us a little update on our current positioning within the portfolios.
Sure. The portfolios continue to be, on the equity side, focused in large cap, high quality, strong balance sheet, more stable earnings, which means a tilt towards defensive sectors. We have a representation in technology, but it's very selective. So it's sort of straddling the fence on growth versus value, with leaning towards value, but definitely towards quality. And in the bond side, the fixed income side, we continue with our short-term, high-quality portfolio as we have been for several years. You may recall we adopted this position several years ago when interest rates were zero on the front end, expecting that we would see increasing rates because of inflation developing. And as everyone knows, the longer the maturity of the bond, the more price risk in that bond. So we've kept a very short maturity, anywhere from 1 to 2.5, 3 years, to insulate the portfolio from the volatility of the pricing of the bonds. And that's worked very well for us.
Thanks, Phil, for your commentary today. We look forward to answering any questions you might have. And as always, you can give us a call and speak with us directly. You can visit our website, or you can send us an email at the attached email address, or scan the QR code to schedule a discussion on the markets in our portfolios. Until the next commentary, thank you for joining us, and we will speak with you then.